Right now, if a tech company associates its name with this logo, the market reacts immediately. A connection to Nvidia is treated as a near guarantee that a company will dominate the next phase of AI infrastructure. That brings us to IREN. They operate as a legacy Bitcoin mining company, but they are currently attempting a massive pivot. They want to transform their existing energy infrastructure into an AI neocloud data center, perfectly positioning themselves to catch that exact market hype. IREN moved to capture this momentum by announcing a 5-gigawatt global expansion roadmap, anchored by a headline-grabbing $2.1 billion agreement with Nvidia. Retail investors piled in immediately, betting heavily on the Nvidia association. The market drove IREN's share price to around $70. But look at the stock price. Shortly after hitting that peak, IREN shares dropped 34%, falling back to $46. The market reversed course almost immediately, despite the multi-billion-dollar headline. This raises a central question. How can a partnership with the biggest name in AI actually become a financial trap for regular investors? To see it, we have to look at the details the market missed. When we hear the word partnership in a press release, it's easy to assume money is changing hands. But a corporate partnership does not equal a direct cash investment. If you read the actual terms of the agreement, Nvidia did not wire $2.1 billion to IREN to help them build their new data centers. Nvidia secured an option to purchase 30 million shares at $70. If the stock rises above 70, Nvidia exercises the option. But if the stock fails to reach that target, Nvidia walks away, losing absolutely $0. Nvidia secured maximum potential upside at zero upfront cost. That means the financial burden of actually building the data centers falls squarely on someone else. Because Nvidia isn't paying up front, IREN has to independently finance the extreme costs of building the physical infrastructure. They have to make themselves valuable enough to trigger that $70 option. IREN's current business is Bitcoin mining. As a physical operation, crypto mining is relatively basic. The hardware sits on open-air racks, and the system can easily tolerate random power outages or scheduled downtime. An AI neocloud is a far more sensitive environment. Enterprise clients demand flawless operational uptime and intense physical security, and the kind of heavy industrial cooling seen here. The engineering required to regulate these temperatures is incredibly expensive. Then there is the hardware itself. To actually process AI compute, the company has to acquire massive volumes of incredibly expensive GPUs. Having cheap electricity and land gets you to the starting line, but upgrading those assets to meet enterprise AI standards requires an enormous, immediate pile of cash. To actually engineer this pivot, IREN has to raise hundreds of millions of dollars right now. And since they don't have direct funding from Nvidia, they have to get it from the market. The fastest way a public company can raise that kind of cash is through an at-the-market offering. They simply create brand new shares entirely out of thin air and sell them directly to the public. This equity pie chart demonstrates the mathematical consequence of that strategy. Every time the company prints new shares to buy GPUs or build cooling systems, the total pool of stock expands. That forces the ownership percentage of existing shareholders to shrink. That's why the market is shifting its attention to competitors like Nebius. They operate with tangible capital structures that are already funded, rather than relying on a cycle of extracting capital from retail investors to build their next facility. Operating in a highly profitable AI sector doesn't matter if endless dilution prevents the original shareholders from actually seeing a return on their investment. To be fair to the bull case, IREN holds very real assets. If they successfully execute their 5-gigawatt roadmap, they have a legitimate path to becoming a massive player in the neocloud space. The bear case, however, centers on the brutal financial reality of getting there. The sheer volume of capital required to build that infrastructure might completely wipe out the value held by early investors before the project is even finished. Investors have to look past industry buzzwords. Terms like gigawatt, capacity, and even partnership are highly effective at generating retail hype, which can be used to mask weak capital structures and aggressive stock dilution. You have to separate the companies that simply have a good operational theme from the companies that actually have a sustainably funded business model. When the next major AI partnership makes headlines, read the contract. You need to know if the tech giant is actually sharing the financial risk of building the future, or if they are just buying a cheap lottery ticket while retail investors foot the bill.